Good morning, guys. Welcome to my YouTube channel. My name is Isaac Kamaldin. So today we'll be discussing on the three things that actually moves the forex market. Because I made a video on swing trading versus day trading. So I said to myself that um because a lot of people actually their perspective, like they actually go for swing trading. So I said to myself that I should make this video so it will guide you guys on your swing trading journey career. So I'm going to list the three things that actually moves the forex markets. The first thing is the value. The second thing is the risk on slash risk off, and the third thing is the liquidity. So we are going to start off with the value. So the value, um when we are talking about the value on how it actually moves the forex markets, is the value actually consists of the three major things, which is the interest rates, inflation rates, and the GDP, the gross domestic product. Or those, like, you might said, some people might be like, what about the news, FOMC, NFP? Guys, FOMC, NFP are crucial news, but then again, they are like the subdivision of the three major parts, the three major things that I just listed now, which is the inflation rates, the interest rates, and the gross domestic product. So that's actually the factors that determines the value of a currency, of the two currency. So whenever, as you guys know, whenever there's an increase in interest rates, the 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 particular currency tends to strengthen. For example, guys, whenever there is an increase in interest rates of the US dollar, there will be a strengthening of the US dollar index. That is, all the GBP USD, Euro USD, and other major pairs will be trending downward. So that's the first aspect of that. And inflation rate, you guys know the meaning of inflation, and you know what it does to a currency. So whenever there's an increase in inflation rates, the currency tends to decrease. The value tends to the currency tends to lose its value. So that's it for the first one, which is the value. The second, risk on slash risk off, is actually the settlement part of it. Actually, the risk on is can be simply like be described as to when the investors are ready to trade, they are ready to invest, there is no any crisis in the world. And which risk off can be described as to there is a when there is crisis in the world, and investing in that particular time will be very very risky. So that's the time we call risk off, the risk off time, which is like an example of it is coronavirus. You guys know how the market tends to behave during the coronavirus. So whenever there is, actually, we are in risk on period now, although not really, like, it is not really like the the liquidity is not there. But then again, we are still in the risk on period currently. But whenever there is risk off period, you get to see that the gold tends to move a lot, because the safe haven assets for the world is the gold, the JPY, the Japanese yen, and the Swiss franc or Switzerland, and the silver too. Those are the four safe haven asset of the world. So whenever there is when there is the risk, whenever we are in the period of risk off, that's the financial instrument that tends to trend during that time. But currently we are still in risk on period, so we should be focusing more on the major pairs, because that's where the money will go. So the third one is the liquidity. The liquidity is can simply be defined like when the value of a currency is known, and the commercial banks, the non-commercial banks, the hedge funds, and the investment banks, they are all trying to place a trade. You guys know everybody cannot place their trade at a time. You guys will have to be very patient. The trades will have to go one after the other. So whenever there is a placing of a trade, that spike moves that happens probably on a Monday morning GPBSD section, as you guys know, probably that those kind of move is called the liquidity. But at the end of the day, the three thing all boils down to the inflation, um inflation rate, interest rate, and the GDP, because without that we cannot know the value of the currency, and if we don't know the value of the currency, everybody won't be trading. If we have to sit on our hands, even the investors banks, they won't be placing any trades by then. So everything tends to but to boils down to that. So I'm going to be doing a full explanation on currency value, which is the interest rate, the inflation rate, and the GDP. I'm going to do a full financial um analysis video on that. So you guys should subscribe to my YouTube channel, like my videos, and comment to get to encourage me to make more videos like this. So that's it for today video, guys. Thank you.